Okay, so let's unpack this. In the world of investing, right, it's so easy to get caught up in, well, the
Oh,
stories.
absolutely. They're everywhere.
Yeah, these really compelling tales, overnight successes, game-changing companies, market wizards, that kind of thing.
Very captivating stuff.
Totally. But here's a thought. What if the real secret to long-term wealth isn't about those flashy stories at all?
Hmm.
What if it's something much more, well, fundamental, maybe even mathematical?
Indeed. And that's exactly what our deep dive is about today. The math behind investing, why returns matter more than stories.
Okay.
We've dug into some really foundational work here. Think John C. Bogle, his Common Sense on Mutual Funds, the little book of common sense
So
investing,
classy.
right? And of course, Benjamin Graham's Timeless, The Intelligent Investor.
Can't talk investing without Graham.
Exactly. So our mission really is to kind of strip away all that market hype and reveal what Bogle calls the relentless rules of humble arithmetic. These are the things that actually drive investment success over the long haul.
Humble arithmetic. I like that.
Yeah. And you might find that the stuff that seems, maybe a bit boring on the surface, that's actually the most powerful way for you to build wealth.
Right. So this isn't about gut feelings or chasing the latest trend or, getting hot stock tips.
Not at all.
This is about understanding principles you can actually measure. Consistent things that have, well, proven themselves over time. Why the numbers often tell a much more reliable story.
Precisely.
So let's jump right in then. We're often drawn to, the next big thing. Everyone's talking about
It's
it.
a siren song.
Yeah. But our sources, they make this really crucial distinction, something that can potentially save you from, well, big losses and a lot of stress. What does Graham say about this?
Well, Graham's thinking here is just fundamental. It's in The Intelligent Investor. He draws a very clear line between investment and speculation.
Okay. What's the difference for him?
An investment, he says, is an operation that, and this is key upon thorough analysis, promises safety of principal and a satisfactory return.
Safety of principal and a satisfactory return.
Both.
Right.
Rigorous requirements, anything else,
Sure.
anything that doesn't meet that bar, he calls it speculation.
Simple enough. But where's the catch?
The catch is Wall Street. You see, the industry itself often blurs that line. They're driven by their own motives, right?
Sure. Making money.
Exactly.
Yeah.
So they often package up highly speculative ventures,
Mm.
wrap them in a great story, loads of hype,
Uh-huh.
and present them to you as perfectly sound investments.
Okay. That sounds risky. Do we have examples of how that plays out, like real-world pain points?
Oh, absolutely. The sources are full of them.
Hmm.
Graham mentions the infamous Monument Internet Fund, launched May 1999, right at the peak of the dot-com craze.
Oh, boy.
Yeah. If you put $10,000 in then, fueled by pure hype, by the end of 2002, you'd had about $2,000 left.
Ouch. An 80% loss.
That's 80% in just over 3 years. Or think about AAA Enterprises. Back in '68, stock sold at $14, shot up to $28 on enthusiasm.
That was good so far.
But by early '71, it was trading for 25 cents.
25 cents.
Yeah. And the company, eventually bankrupt. And look, this isn't ancient history in principle. It echoes that dangerous new era investment idea from the 1920s.
Right, before the crash.
Exactly. Where people completely disconnected how desirable a stock seemed from its actual price or value. It's a pattern, you see. Because we just love a good story.
Wow, those are brutal examples. Really hammers home the danger of chasing the excitement. But, okay, isn't there still a case for trying to find those genuinely amazing companies? The ones with obvious growth potential, even if it borders on speculation? What's the trap there?
That's a really good question, and it gets to the heart of the illusion. Graham explains it perfectly. Obvious prospects for physical growth in a business do not translate into obvious profits for investors.
Why not? If growth is obvious.
Because the market isn't dumb. It's usually incredibly efficient at pricing and expectations. If a company or an entire industry has really clear growth potential, guess what?
It's already baked into the stock price.
Exactly. It's usually already reflected in the price, often leading to overvaluation. Look at Intel back in 2000.
Okay.
They announced expected revenue growth, maybe up to 5% for the next quarter. For a huge company, that sounds pretty good, right?
That's solid.
Their stock dropped 22% in one day.
22%. Why?
Because analysts, the market, they expected 10% growth. The obvious growth wasn't just priced in. The market demanded even more. When reality didn't meet those sky-high expectations, crash.
Okay, wow. So market isn't just sitting there waiting for you to find the obvious story. It's often way ahead.
That's the crux of it. Success often comes from understanding that the market price and the actual underlying value, they aren't always the same thing, especially when hype takes over.
That first point is powerful. How easily we get seduced by the story, missing the risks the numbers might show. Okay, let's shift gears a bit from those big, exciting stories to something maybe less glamorous, but wow, does it impact your bottom line? What do these principles mean for your actual wallet? Our sources just keep hammering this home. Cost matters. And the math, it's kind of relentless, isn't it?
It really is. Relentless is a good word. The true shocker often comes when you see how tiny-sounding annual costs can just devastate your wealth over the long term.
Right.
John Bogle's work, especially Common Sense on Mutual Funds, lays this out so clearly. The humble arithmetic, as he calls it. Let's break down some of these costs that quietly chip away at your return.
Okay, what are we talking about?
Well, first, there are operating expenses. Think about an aggressively managed fund, maybe small-cap stocks. Total charges related to assets can hit like 3% a year.
3%.
Yeah. Now compare that to a simple market index fund. It might run on 0.20% or even less. Huge difference right there.
A big difference. What else?
Then you've got sales loads. Like a front-end load, maybe 5%. That's a fee you pay just to buy into the fund. Spread that over 10 years, and it's costing you about 0.5% per year.
Just for the privilege of investing.
Pretty much. And then there are the sneakier ones, like 12b-1 fees. These are named after an SEC rule, often kind of hidden loads. They can shave off another 1% from your annual returns.
1%? What are they even for?
Often they pay for marketing, sales promotion, stuff that, as Bogle says, provides no net benefit whatsoever to you, the investor.
But it comes out of my return.
Comes directly out of your pocket, yeah.
And wait, there's more, right? The active funds, they buy and sell a lot.
Exactly. That leads to hidden portfolio turnover costs.
Yeah.
Actively managed equity funds, on average, turn over their portfolios maybe 80%, even 100% annually.
Meaning they replace almost everything in the fund every year.
Yeah, lots of buying and selling. All that activity generating transaction costs, brokerage fees, market impact costs. That can easily add another 0.5% to 0.8% per year in costs. And who pays for that?
The shareholder.
You do. And as Bogle points out, there's absolutely no evidence whatsoever that all of this feverish activity enhances the net returns they receive. It's just activity, costly activity.
Wow. So operating expenses, sales loads, 12b-1 fees, turnover costs, they really add up.
They add up significantly. And the long-term impact, it's genuinely staggering when you run the numbers.
Okay, give us a scenario. Make it real.
All right. Imagine you start with $10,000 today. You're saving for retirement, say, over 50 years.
Long haul.
Right. Let's assume the stock market gives you an average 8% annual return. Sounds pretty good. That $10,000 could grow to nearly $500,000, about $469,000.
Okay, nice nest egg.
But now let's say you put that money in an average actively managed mutual fund. And let's be conservative. Say it has combined costs of 2.5% per year.
Which sounds plausible based on what you just listed.
Very plausible. Your net return instantly drops from 8% to 5.5%. So after 50 years, that same $10,000, it grows to only about $145,400.
Wait, go back. $469,000 versus $145,400.
Yep, let me do the math. A staggering $323,600 difference. Lost entirely to costs, not market downturns, just fees.
That is horrifying, actually. Over 2/3 of the potential gain vanished.
And for bond funds, it can be even worse percentage-wise. The highest cost funds might eat up over a third, like 34% of your total return. Compare that to maybe 6% for a bond index fund.
Okay, that's crystal clear. Costs are a killer. And isn't there something else that makes active funds look better than they are? Survivor something.
Ah, yes. Good point. Survivor bias. Crucial concept. Our sources show that about a fifth, maybe 20% of mutual funds that exist at the beginning of a 15-year period, they just disappear.
Because they fail, close down.
Exactly. They perform poorly, merge, liquidate, whatever. But they're bad track records. They often get excluded from the performance averages reported for actively managed funds.
So the reported average only includes the funds that manage to survive?
Right. Which artificially inflates the apparent success of the winners. Potentially by a lot, maybe 1.4 to 4.2 percentage points per year, according to some studies. It paints a much rosier picture than reality.
So the deck is kind of stacked against you seeing the true cost and underperformance picture?
It can be, yeah. It all comes back to what Bogle calls the tyranny of compounding. Small differences in net return year after year. They lead to increasing and finally staggering differences in capital accumulation. Costs work the same way, but in reverse.
Okay, so if costs are the villain here, quietly stealing our future wealth, what's the hero in this mathematical story?
Hmm.
Our sources seem to point towards something really simple, almost humble, something that kind of pushes back against all that hype we started with.
And you've hit on it. The counterintuitive champion here is indexing. Bogle describes it beautifully as simplicity writ large.
Indexing, meaning just buying the whole market, basically.
Essentially, yes. An index fund simply buys and holds the securities in a particular index, like the S&P 500, in proportion to their weight.
So no trying to pick the winners or avoid the losers.
Nope. No stock picking gurus, no market timing attempts. You just own the market,
Yeah.
or a slice of it.
Hmm.
And because of that simplicity, it bypasses most of those costs we just talked about.
Right. No high advisory fees.
Minimal operating expenses.
Right.
Very low portfolio turnover because you're just holding.
Okay, makes sense. And does the math actually back this up? Does it win?
Overwhelmingly, yes. The data is incredibly consistent over long periods. The S&P 500 index, for example, has historically beaten the average actively managed U.S. stock fund by about 1.3 to 2.5 percentage points per year
After costs, I mean.
after costs, which means the index fund effectively captures something like 99% of the market's total return, while the average active fund manager actually subtracts value through costs and often poor timing or stock selection.
Wow. 99% versus
Ugh.
much less.
Yeah. And this isn't just a theory anymore. Investors are catching on. Bogle calls it the triumph of indexing. Index fund assets went from just 3% of equity fund assets in 1995 to 11% by 2009. And it's grown massively since then. People are voting with their wallets.
That's a powerful trend. And it's not just Bogle singing this tune, is it? I remember reading that other investing legends agree.
Absolutely. It's a remarkable consensus, really.
Yeah,
You've got Peter Lynch, arguably one of the greatest stock pickers ever.
the Magellan Fund guy.
That's him. He famously said, most investors would be better off in an index fund.
Even the master stock picker says that.
Right. And Charles Schwab, who built a giant platform selling all kinds of funds, he says only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing. And even Benjamin Graham himself, near the end of his life, and certainly his most famous student, Warren Buffett, have repeatedly praised simple, low-cost index funds as the smartest choice for most individual investors.
When Graham and Buffett are on board, that carries serious weight. It really makes you question why anyone would choose the high-cost, complex route.
It really should. And beyond just the lower costs, indexing has other mathematical advantages working for you.
Like what?
Well, tax efficiency is a big one. Because index funds buy and hold, they have very low turnover, remember?
Right, not much selling.
So they don't generate many taxable capital gains that get passed through to you each year. They're inherently tax efficient. Active funds, with that high turnover, they're constantly selling, realizing gains, and creating tax bills for their shareholders. They're often very tax inefficient.
So you keep more of your return after taxes, too.
Exactly. One Vanguard S&P 500 fund, Bogle studied, for instance, beat 94% of its peers before taxes over 15 years. But after taxes, it beat 97%. The tax drag on active funds is real.
Okay, that's another hidden cost, almost. What else?
Risk control. This is subtle but important. While nobody can predict future returns accurately. Right. But we can predict differences in relative risk among funds much more reliably. Low-cost index funds generally give you better risk-adjusted returns.
Meaning more bang for your risk buck?
Basically, yes. Studies show the lowest expense funds tend to have significantly better Sharpe ratios. That's a measure of return per unit of risk, maybe 15% above average. With an index fund, you're essentially taking on only market risk, the unavoidable risk of the market going up or down.
Okay.
You largely avoid style risk, the risk that, say, growth stocks underperform value stocks for a period. And you totally avoid manager risk, the risk that your specific fund manager makes bad bets or just underperforms.
So fewer ways to lose, essentially. You're just riding the market's overall tide.
Precisely. That simplicity, combined with those minimal costs, lets you capture nearly all of the market's return, which comes from the fundamental economic growth of companies, their earnings, and dividends. Our sources confirm that those are the real long-term drivers of stock returns. Indexing lets you harness that directly.
That's a really compelling case for just keeping it simple and cheap with indexing. But okay, beyond costs and market exposure, what else does the math tell us? Is there another big principle we should expect to see play out over the long term?
Yes, there absolutely is.
Yeah.
Another powerful force our sources highlight. It's often called mean reversion.
Mean reversion sounds statistical.
It is, but think of it as maybe a first principle of financial physics.
Okay, I like that. What does it mean?
It means that things tend to revert back to their average over time. In investing, even the funds with the very best past records have a strong and, in the long run, overpowering tendency to gravitate to average gross returns,
So today's winners are likely tomorrow's average Joes.
and hence below average net returns
Cool.
because of those costs we keep talking about. Past performance is truly not indicative of future results,
Mhm.
especially sustained outperformance.
Is there data on this?
Oh, yeah. Bogle cites studies showing, for example, that funds ranked in the top quartile the best 25% in one period, subsequently lost most of that edge. One study found they lost 3.9 points of their previous 4.7-point advantage.
Wow.
And in that group, fully 30 out of 34 of those top funds reverted back towards the average performance. It's almost like Newton's third law in finance, you know?
Yeah.
Every action has an equal and opposite reaction. Extreme outperformance often seems to be followed by underperformance or just average performance.
So chasing last year's winners is probably a losing game.
Statistically, yes.
Yeah.
Especially once you factor in the costs of chasing them. It just reinforces that trying to consistently beat the market is incredibly difficult, maybe even impossible for most, over the long run.
It really brings those four dimensions of investing into focus, doesn't it? Cost, reward, risk, and time. Time enhances the good stuff returns, but it also reduces certain risks while magnifying the bad stuff, the impact of costs. You really have to consider all four.
Absolutely. And this contrasts sharply with short-term speculation. Stock valuations like price to earnings or PE ratios, they can bounce around a lot in the short term.
Yeah, market sentiment, hype.
Right. That's what Bogle calls speculative return. But the sources are clear. In the long run, reality rules.
Yep.
And reality is the underlying growth in corporate earnings and the dividends they pay out. That's the investment return.
So trying to guess the PE ratio swings. That's
What?
speculation again.
Pretty much.
Yeah.
While periods of multiple expansion where PE ratios rise and boost stock prices beyond earnings growth have definitely contributed to returns sometimes, trying to forecast when that will happen, it's virtually impossible, according to Bogle. Not a reliable strategy. It's another one of those siren songs.
Okay. So pulling this all together, what does this mean for you listening right now? Our deep dive into the math, into the numbers behind investing. It seems to consistently point away from chasing exciting stories
Yeah.
and away from paying high costs for active management that rarely delivers on its promises long term.
That's the clear message from Graham and Bogle.
The winning strategy, at least mathematically speaking, seems to be about embracing simplicity, keeping costs incredibly low,
Crucial.
and committing to a long-term diversified approach like indexing that really harnesses the power of compounding and accepts that things like mean reversion are just part of the game. It's about letting the math work for you, not against you.
Exactly right. Investing, when you look at it this way, it's maybe less about being brilliant or clever
Right. Less about genius stock picks.
and much more about being patient and disciplined. It's about recognizing what you can control.
Which is?
Your costs,
Yeah.
your asset allocation, how you divide money between stocks, bonds, etc., and your time horizon, how long you stay invested. Those things matter far, far more than trying to predict the unpredictable or finding the next hot story.
Mm-hmm.
It reminds me of that great quote from Benjamin Graham himself. He said, "The defining trait of an intelligent investor is more of the character than of the brain. Discipline, patience, temperament over sheer intellect."
Character over brain. I like that. It brings it back to us, to our own behavior. Okay, so for you, our listener, here's maybe a final thought to chew on as we wrap up. If mathematical evidence, the humble arithmetic, points so strongly towards low-cost, long-term passive investing, why? Why do so many really smart people still get lured in by the hot story? Why do they keep chasing the promise of beating the market despite the odds?
That's the million-dollar question, isn't it?
Yeah. What is it about us, about human nature maybe,
Yeah.
that makes accepting the straightforward math so difficult and makes those dazzling narratives just so hard to resist? Something to think about.